Welcome to Sidekick TV. I'm your host Rick Thorpe, and in this series with JMI Wealth, I interview Greg McGeorge. Greg has over 35 years experience across New Zealand and the UK, and JMI Wealth has over $6 billion invested across its multiple entities. In this series, we're talking all about financial markets, what's going on with investments, and so if you want to hear more about this, please do subscribe, and if you're listening on Spotify, you'll be able to get all of the content there, and on YouTube, you'll also get some of the visuals if there are graphs and things like that. So go and find us on all of the channels. We look forward to it. Cheers. Please, Greg, tell us, what are the key points from January's articles?
The two key points I want to talk about today that I see popping up most across the various financial news sites is talk about the concern around growing government deficits. And of course, the big one was the Bitcoin exchange traded fund now being approved by US regulators. But if we start with the growing government deficits globally, concern is really growing over deficits, and it's something that's been grabbing, I notice, a lot of attention, not just in the last month, but in the last few months. And while governments often run deficits without investors being overly concerned, i.e. governments spend more than what they take in from taxes and have to therefore borrow the rest, the current situation is causing some highly regarded commentators to send out dire warnings about the consequences. The US Treasury this year will issue around $4 trillion US dollars of debt. That's up from $3 trillion US last year and 2.3 in 2018. The current concern among investors about large government deficits arises from a combination of factors. The size of the deficits. If government deficits are exceptionally large, as they are now, for a prolonged period, they start to have a snowball effect and accumulate into a significant amount of debt, raising questions about the government's ability to manage its finances. Another issue investors are worried about is the current economic climate. During economic downturns, governments implement stimulus packages and increase spending to support the economy. This is normal and accepted by the markets to a certain extent. But global economies have actually been doing okay post-COVID with healthy tax takes. So deficits should therefore be coming down, but they're only getting worse. So what's going to happen to the deficits when we hit our next recession?
So Greg, what else are investors concerned about?
Interest rates are also proving to be a concern as well. When interest rates are low, obviously the cost of borrowing is more manageable for governments. However, interest rates have risen quickly over the last few years, meaning the interest cost on the ever increasing deficit means governments have to either borrow more to help pay for these higher interest costs, or look to cut back spending that will then, of course, divert money away from essential public services, social security, or investments. But while deficits may be out of control, the real story and fear amongst investors is that there appears to be no mechanism or appetite for bringing them under control. With half the world's population heading to the polls this year, there seems to be little or no willingness from governments to curb the spending. Elections mean political leaders will start promising to raise spending to buy their votes. As the US gears up for its presidential election in November, for instance, there's little sign either party will be willing to restrain its spending.
Wow. Greg, this bit sounds very exciting to me. So this is the emergence of bond vigilantes. Please tell us more.
Well, governments don't necessarily need to start running surpluses to make up for years of running deficits. As the economy grows, tax revenue tends to grow with it, and the existing load of debt becomes more affordable. Governments can even afford to run small deficits and still grow its way out of its debt problem. But today's deficits are far above what's sustainable. coupled with the lack of desire to tackle them, is causing investors to worry. And this leads us to what could happen next and the possible emergence of bond vigilantes. So bond vigilantes are those investors who threaten to sell or actually do sell large amounts of bonds to protest against the policies of the government or the central bank.
So Greg, can you tell us an example, please, of bond vigilantes at work?
Sure. Well, the idea being, if the government or central banks won't regulate the economy, the bond investors will, or these bond vigilantes. And they do it by selling the bonds, and selling bonds depresses their prices, simple supply and demand. And as you sell and the price goes down, there is an inverse relation, so interest rates correspondingly push up, making it more costly for borrowers, as simple as that. And perhaps the best example of bond vigilantes at work most recently was the historic bond market sell-off that greeted former UK Prime Minister Liz Truss's disastrous mini-budget in September 22, which included a raft of unfunded tax cuts. The bond vigilantes lashed out at what they deemed to be irresponsible government spending policy. The plan sent the British currency tumbling to its lowest level ever against the US dollar and caused the biggest spike ever in UK interest rates. That then created a problem for pension funds that hold a lot of government debt, and it was only when Liz Truss resigned and the UK central bank had to step into the market and buy government debt did some sort of normality return to the market.
So what next?
Well, the market will play along for only so long before it decides enough is enough and have its say. We will, of course, blame the market for the turmoil and chaos that it causes, but the reality will be we let it happen to ourselves.
So, Greg, tell us about the second big talking point of the month, the Bitcoin ETF.
That's right. The other big talking point in January was Bitcoin going mainstream with a new exchange-traded fund, or what's known as an ETF. In January, the US financial market regulator, the SEC, approved its first Bitcoin ETF. An ETF is a type of investment fund that allows retail investors, mum and dads, to buy and sell shares in it, and it's traded on a stock exchange in exactly the same way that you might buy and sell shares in a company, therefore allowing the retail investors, in this case, to get exposure to Bitcoin. Although by buying shares in the ETF, you don't actually own Bitcoins directly, you instead end up owning shares in a company that holds Bitcoin. So what that means for retail investors is you don't need to worry about setting up digital wallets, memorizing keys, or creating an account with a crypto exchange.
So Greg, how does an ETF work then?
An ETF is created by an investment company, referred to as the fund sponsor or issuer. Some of the biggest investment managers in the world, the likes of BlackRock, Fidelity, Invesco, have all set up new Bitcoin ETFs. And ETFs work slightly differently to your usual mutual fund, whereas a mutual fund will issue an end-of-day price that you can buy or redeem the units at, called the net asset value or NAV, and that NAV is based upon the actual assets that the mutual fund own. But with an ETF, it's traded like a share on the stock market. So therefore, if you have more buyers than sellers, potentially the price of that share can move higher than the underlying reference point, which of course in this case is the price of Bitcoin, and vice versa. If you have more sellers of the shares than buyers, it will push the price down below potentially the reference of the Bitcoin.
So Greg, what happens then when the share price perhaps moves away from the Bitcoin price?
There are mechanisms in place to ensure the share price does trade in line with the underlying Bitcoin price. but it's not always perfect. For instance, BlackRock's new Bitcoin ETF was trading 10% higher than the actual underlying Bitcoin price shortly after it launched. So to ensure the share price does trade in line with the underlying security, ETFs like BlackRock rely on what is called authorized participants to supply them with the underlying Bitcoin. And how it works is the authorized participants will deliver Bitcoin to the ETF issuer, or BlackRock, let's say, and in return for those Bitcoins, the ETF issuer, like BlackRock, will issue new shares to the authorized participants. Now, these new shares are then traded on the secondary market by the authorized participants. So what would happen if the share price does rise above the Bitcoin price? The authorized participants sell a bunch of Bitcoin to BlackRock. BlackRock then give them more shares. The participants then sell those more shares on the stock exchange, and under simple supply and demand, you should then see the share price drop back in line with the Bitcoin price, and vice versa. If you have too many sellers, the authorized participants will buy Bitcoin back off and return shares. So this creates an opportunity for the authorized participants to make money on what's referred to as an arbitrage trade. So they can buy the underlying Bitcoin at a cheaper price, deliver it to the BlackRocks of the world, and get a higher price share back in return.
So Greg, do you think this is Satoshi Nakamoto's dreams come true?
There is a certain irony to the new Bitcoin ETF, as now Bitcoin has joined mainstream investing world and finance. And yes, you're right, it's something our fictional creator Satoshi Nakamoto probably never imagined back in 2009 when he created Bitcoin. At the time, his goal was to create an alternative financial system away from the prying eyes of central government and mainstream finance. But the success of Bitcoin as a payment system has been a failure. It's been limited because it's too cumbersome and too slow to verify transactions. Instead, Bitcoin has now become a store of value and merely a vehicle for speculation. So Wall Street and the mainstream banking system seem to have hijacked Bitcoin to generate fee income for themselves, a system that was designed to be a competitor to their payment system. So I'm sure the real Bitcoin true believers must despise this latest development.
Okay, Greg, and give us an update. What everybody wants to know, how's your rowing challenge going?
Good. January was a record month for me, so I'm trying to do my 2 million metres on the erg row over a period of 1st of May to the 30th of April. So I'm now up to 1.4 million metres, 600k to go. I'm very much looking forward to finishing it, and after this, yes, I will be jumping on the erg and getting my 7,238 metres which I have to do every day now between now and the end of April.
Wow. And
I will be putting my erg up for sale when I've done it. I do not want to see one again.
And I understand at the gym we both go to, how's your 2K fast challenge going?
It was going well until I had to stop 200 metres short of my challenge and run to the bathroom and throw up. So I'll be taking it a bit easier next time.